A small group of men step off a private train under the cover of darkness. No names on the tickets, no reporters on the platform. Just an unmarked car waiting in the cold night air and a list of instructions that sound more like spycraft than finance. Don't use your last names. Don't speak to anyone on the way if someone asks what you're doing. Say you're going on a hunting trip. They move quickly, collars up, breath visible in the air, toward a boat that will take them to a private island off the coast of Georgia. Behind them is a decade of financial chaos. Ahead of them is something much bigger. They are not just there to talk about banking. They are there to redesign the rules of money itself. The island is Jekyll Island, a quiet playground for America's richest families, where Rockefellers and Morgans and Astors come to escape the noise of the cities. But for 10 days in November 1910, it quietly becomes something else, the hidden workshop where the blueprint for the most powerful financial institution in modern history is drafted. The Federal Reserve does not yet exist. The dollar is still tied to gold. The United States has no central bank. What they build here will change all three. To understand why these men are sneaking off to a private island, you have to rewind 3 years, to 1907, when the United States banking system nearly implodes. A wave of panic rolls through New York. Depositors rush to pull their money out of banks and trusts. Lines spill onto the sidewalks. Rumors spread faster than facts. Institutions that looked solid on paper are suddenly begging for cash. There is no official lender of last resort. No central bank to coordinate a rescue. No safety net. Just one thing, the personal fortune and influence of J.P. Morgan, in his library under the glow of lamps. He gathers leading bankers, locks the doors, and forces them to agree on a private bailout to stop the collapse. They argue, they hesitate, they sign. It works, barely. The system survives, but the message is clear. A modern industrial empire is depending on improvisation and backroom deals to keep its money system alive. Congress is embarrassed. Wall Street is shaken. The public is furious. In response, Washington passes new legislation and creates the National Monetary Commission. A team tasked with a simple but impossible job: study the world's banking systems and design a plan to fix America's chaotic structure. Senator Nelson Aldrich, a powerful Republican with deep ties to finance through his family and his connections, is put in charge. He spends years traveling through Europe, interviewing central bankers, observing institutions like the Bank of England and the Reichsbank, and studying how they manage crises and control credit. By 1910, the clock is ticking. Aldrich is expected to come back with a concrete proposal. But he has a problem. Any plan that looks like it hands more power to Wall Street is politically toxic. Populists distrust big banks. Progressives fear private monopolies. The public still remembers the panic of 1907, and they know who the winners and losers were. Yet the people who actually understand the system are the bankers themselves. So Aldrich does something bold. He quietly invites a handful of the most influential figures in American finance and government to a secret meeting. The guest list is small, but the balance sheets behind it are enormous. Nelson Aldrich, the senator; Piatt Andrew, the assistant secretary of the Treasury; Henry Davison, a partner at J.P. Morgan and co-Frank Vanderlip; president of National City Bank of New York, Paul Warburg, a partner at Kuhn Loeb; and one of the few Americans who truly understands European central banking, Arthur Shelton, Aldrich's secretary. They are told to travel alone, to arrive separately, to use first names only. They are told to avoid being seen together on the train. They are told to answer no questions about the trip. Officially, they're going on a duck hunting trip. In reality, they're about to draft the first version of what will become the Federal Reserve System. Inside the Jekyll Island Club, with its polished wood, high ceilings, and servants sworn to discretion, they sit down with a problem that's as old as trade. How do you create a money system stable enough to support an empire, but flexible enough to rescue that system when greed and fear push it too far? The United States in 1910 has thousands of small banks, scattered across states, all holding reserves in a fragmented, pyramidal structure. Money is inelastic. When people want cash at the same time, there isn't enough. Reserves are stuck in the wrong places. A local panic in one city can drain reserves from another. Panics start small and then spread through this fragile network like fire through dry grass. The solution they start sketching is radical for America, but familiar in Europe. Instead of each bank hoarding its own reserves and collapsing alone, they will be linked through a central institution. That central body will hold reserves, issue a national currency, and act as a lender of last resort in times of crisis. When fear spikes, this institution can create liquidity and push it where it's needed most. When speculation runs wild, it can tighten conditions. In their draft, it's called the National Reserve Association. It will pool reserves nationally instead of letting them sit idle in scattered vaults. It will issue a unified, elastic currency to replace the patchwork of banknotes. It will rediscount commercial paper, which means it can buy up short-term loans held by banks and give them cash in return. It will act as fiscal agent for the government, handling its payments and bond sales. In plain language, they are building a prototype central bank. Paul Warburg, who has seen how the European systems work, pushes hard for a central institution with the explicit power to expand and contract credit as needed, smoothing out booms and busts, preventing panics from spiraling into full collapses. They argue over the details. How much power should the central body have? How should it be governed? Who should sit on its board? How will smaller banks be represented? How will they sell this to Congress without making it look like a Wall Street takeover? They write drafts, cross out paragraphs, rewrite them. Days blend into nights. By the time they leave Jekyll Island, they believe they've done it. They've designed a plan that can fix the broken plumbing of American finance. But they also understand how it will look to the public, 6 men, all tied in some way to the largest financial interests of the country, meeting in private on a secluded island, designing the architecture of a new money system. So they keep it quiet. For years, they deny the meeting happened. Names are omitted, details blurred, stories softened. Only decades later, in memoirs and interviews, will participants openly admit that this gathering took place and that its blueprint, the Aldrich Plan, heavily influenced the system we know today. When Aldrich brings his plan back to Washington, it immediately runs into trouble. The optics are terrible. The country has just watched Wall Street nearly blow itself up, and now Wall Street's own allies are presenting a solution that centralizes even more power into a single institution dominated by bankers. Populists call it a banker's charter. Progressives see a private cartel stamped with government approval. The Aldrich Plan stalls. Then the political winds shift. In 1912, Woodrow Wilson wins the presidency, and Democrats gain control of Congress. Banking reform is not dead. In fact, it's one of the hottest issues in the country. But now it will be rewritten on Democratic terms. 2 key figures step forward. Congressman Carter Glass and Senator Robert Owen. They take the core idea of Aldrich's plan, a central reserve system, and reshape it into something they believe the public can accept. Their version is the Federal Reserve. Instead of one monolithic National Reserve Association controlled by New York bankers, they propose a federal structure, multiple regional Federal Reserve banks, each serving a district, supervised by a central Federal Reserve Board in Washington. Private banks will be required to join the system and own stock in their regional reserve bank, but the central board will be appointed by the president and confirmed by the Senate. Power is split between public and private, center and regions, at least on paper. 2 supporters, it's a brilliant compromise. It promises the expertise and flexibility of a central bank without openly handing total control to Wall Street. 2 critics, it's still a cartel, just one with a more complicated map and a government seal on the front. The bill moves through Congress under intense debate. Amendments are debated, provisions tweaked, language softened to calm fears of monopoly. In December 1913, just before Christmas, the Federal Reserve Act is passed and signed into law. The United States officially has a central bank again, for the first time since Andrew Jackson killed the second Bank of the United States almost a century earlier. The stated goals sound modest and technocratic, provide a safer, more flexible, more stable monetary and financial system, furnish an elastic currency, create a more effective mechanism for rediscounting commercial paper, and improve supervision of banking. But behind those dry phrases lies a deeper shift in how power works. Before the Fed, money in the United States is shaped by gold flows, private credit decisions, and the willingness of individual bankers like J.P. Morgan to coordinate rescues in a crisis. After the Fed, a single institution gradually gains the power to expand or contract the money supply, influence interest rates, and act as ultimate backstop for the entire banking system. To see how that works, strip away the jargon and look at the core mechanics. At the heart of the new system are 12 regional Federal Reserve banks and a central board, commercial. Banks in each district hold accounts at their regional Fed. Those accounts hold reserves special, balances that only exist inside the banking system. When the Fed wants to make conditions looser, it has several tools. It can lend to banks directly, accepting good collateral and crediting their reserve accounts. It can purchase assets, like government securities, from the banking system, paying for them with newly created reserves. It can lower the rate it charges on its own loans to banks. Over time, one tool becomes the most important: open market operations. When the Fed buys securities, it injects reserves into the system. When it sells them, it drains reserves. Banks with more reserves can make more loans relative to their reserve base. More loans mean more deposits, more credit, more spending power circulating in the economy. In everyday language, that means this: the Fed can create new base money at will and decide where it enters the system first. This is where the story stops being just about history and becomes directly relevant to you. Because whenever new money enters an economy, it doesn't fall from the sky evenly on everyone at the same instant. It comes in through specific channels, through banks, through financial markets, sometimes through government spending. The people and institutions closest to those channels get to use the new money first, before the rest of the system has fully adjusted. The effect is subtle but powerful. Imagine new money pouring out of a fire hose. The people standing closest get soaked first. They can use that new money to buy assets, pay wages, or acquire resources at old prices. By the time the water has trickled through the whole crowd, prices have risen. The late receivers get the same units of money, but with less purchasing power attached. In economics, this is often called the Cantillon effect, the idea that the first recipients of new money gain at the expense of the later ones. When a central bank steps in during a crisis and buys hundreds of billions in assets from large financial institutions, it is acting to stabilize the system. But the path those new dollars take matters. If they first land on the balance sheets of big banks, dealers, or asset managers, the first things they tend to support are asset prices: stocks, bonds, real estate, complex financial products. Over time, this can quietly inflate the value of assets primarily held by the wealthy, while the purchasing power of wages and cash savings erodes more slowly in the background. Even if the official goal is stability, the side effects are distributional. Some people are standing right next to the hose. Others are far from it, catching the mist. The men on Jekyll Island were not using phrases like quantitative easing or forward guidance, but they were absolutely focused on who would control the spigot. Their plan assumed that those closest to the center of the system, the large banks, the reserve banks, the policymakers, would be the ones managing the flow. To them, that made sense. They saw themselves as stewards. To you, more than a century later, it raises a different question. What happens when the ability to create and channel money is concentrated in the hands of a small group of insiders? Even if they operate within a legal, institutional framework. This is the quiet lesson of Jekyll Island. It is not that a handful of men invented a cartoon villain conspiracy in a smoke-filled room. The reality is more mundane and more unsettling. A real meeting did happen. Highly influential bankers and officials did gather in private. They did write the initial blueprint for a new reserve system. Their plan did heavily influence the ultimate structure of the Federal Reserve, and over time, that institution did become one of the most powerful forces in the global economy. Today, a single sentence from the chair of the Federal Reserve can move trillions of dollars in a single afternoon. A small change in interest rates can reprice mortgages, corporate debt, stock valuations, and government deficits across the entire world. In moments of crisis, the Fed can create money in quantities that would have been unimaginable in 1913 and deploy it in days. The surface story is always the same: protecting stability, preserving confidence, preventing collapse. But beneath that story is a permanent structural reality. When you centralize the power to create money, you centralize the subtle power to decide who benefits first. And that brings the camera back to you. Most people hear the words Federal Reserve and switch off. It sounds dry, technical, remote. Something for economists in suits and traders on screens. But behind that dull name lies one of the most important leverage points in the system that shapes your life. When your savings buy less each year, the Fed is somewhere in that story. When asset prices soar while wages lag far behind, the Fed is somewhere in that story. When financial crises seem to end not with punishment for the reckless but with new lifelines of liquidity, the Fed is somewhere in that story. Understanding how it began on a private island, in deliberate secrecy, with a small group designing a structure that would outlive them, doesn't give you all the answers. But it gives you something better: context. Once you see that money is not a neutral, natural force but a set of rules written by specific people, in specific rooms, at specific moments in history, You stop treating it as sacred and start treating it as designed. And anything designed can be questioned. The men leaving Jekyll Island in 1910 probably did not imagine a world of high-frequency trading algorithms, cryptocurrencies, and globalized capital flows flashing across borders in milliseconds. They were trying to end the chaos of bank runs and prevent a repeat of 1907. They succeeded on their own terms. They built a machine that could stabilize crises with the push of a button by creating liquidity out of nothing. They built an institution that would sit above day-to-day politics most of the time, but never entirely outside it. They built a structure that would, intentionally or not, tilt the playing field toward those closest to the center. A century later, you are living inside the consequences. The next time you hear that a handful of officials met behind closed doors and decided to change interest rates, expand the balance sheet, or launch an emergency facility, remember this: once, long ago, a small group of men boarded a private train with no names on the tickets, vanished to an island, and quietly rewrote the architecture of American money. The meeting ended. They went home. Newspapers moved on. But the world had already shifted. History doesn't repeat. It compounds. And the game that started on that private island is still being played, with your savings, your debt, and your future as pieces on the board,